In the mid-2000s, Iceland's banks became some of the fastest growing in the world. They expanded across Europe, raised money abroad, and grew far larger than the Icelandic economy itself. For a while, the system appeared to work. Credit was available. Asset prices rose. Iceland looked like a modern financial success. Then, in 2008, nearly the entire banking system collapsed in a matter of days. What followed shows how outcomes form when growth depends on conditions that can't be supported once pressure arrives. At the time, the story seemed straightforward. Iceland's banks had become ambitious. They borrowed heavily. When the global financial crisis hit, they failed. That explanation focuses on speed and scale, but it does not explain why losses landed where they did, or why Iceland's outcome looked different from many other banking crises. To understand that, it helps to look at how the system was set up. In the early 2000s, Iceland made major changes to its financial system. The country privatized its main banks, Kaupthing, Landsbanki, and Glitnir. Rules around international borrowing were loosened. The banks were encouraged to compete globally, and so they did. The banks raised large amounts of money outside Iceland, mostly in euros and other foreign currencies. They used that funding to buy companies across Europe and to offer high-interest savings accounts in countries like the UK and the Netherlands. At the same time, their assets were long-term. Loans, acquisitions, and investments could not easily be sold or unwound. This created a quiet imbalance. The banks relied on funding that could leave quickly, but their assets were slow to change. Iceland still controlled its own currency, but it did not control the foreign currencies its banks depended on. As long as international lenders were willing to continue funding Iceland's banks, the system functioned. From the outside, the structure appeared manageable. The banks were profitable. Their businesses were expanding. Iceland's economy benefited from the inflows. Investors assumed that, in the event of collapse, the Icelandic government would stand behind the banks, just as other countries had done elsewhere. But Iceland was small, while their banking system was not. By 2008, the bank's combined size was many times larger than Iceland's economy. That difference mattered, but only once conditions changed. The shift came during the global financial shock of 2008. As stress spread through credit markets, lenders became cautious. Short-term funding dried up across Europe and the United States. This spelled great trouble for Iceland's banks. They needed foreign currency and new loans to continue operating. But the Central Bank of Iceland could not supply euros or dollars in large amounts. Confidence changed quickly. Lenders stopped renewing funding. Foreign depositors became concerned. Liquidity vanished. Within days, all three major banks failed. Once the system broke, outcomes followed the structure already in place. Shareholders were wiped out. The banks themselves were taken over by the Icelandic authorities. Foreign creditors soaked large losses. Their claims were frozen and later restructured, often for fractions of what they were worth. Domestic banking functions were separated and preserved. New institutions were created to handle everyday lending and deposits inside Iceland. Crucially, the Icelandic government did not fully assume the bank's foreign debts. Those losses stayed largely outside the country. The national currency fell sharply. Imports became more expensive. Households experienced a decline in their purchasing power. But the domestic financial system continued to function. To stabilize conditions, Iceland imposed capital controls. These limited how quickly money could leave the country. They reduced immediate pressure on the currency and the banking system. The controls were controversial, but they bought time. Over the following years, the banking sector became much smaller and more focused on domestic activity. Iceland avoided a prolonged banking freeze, even as it absorbed a sharp adjustment. Iceland imposed strict capital controls until 2017, nearly a decade after the global financial crisis. the effects extended beyond finance. The weaker currency made Iceland more competitive abroad. Tourism expanded. Exports became more attractive. Inflation rose initially, then stabilized. Economic growth returned faster than many expected. Internationally, the episode challenged assumptions about government guarantees. It showed that, under certain conditions, losses could remain with creditors, even in advanced economies. The Icelandic banking collapse was not sudden or random. It followed from how the system was built. Growth depended on foreign funding that Iceland could not support on its own. When that funding disappeared, resolution followed the existing structure. Losses moved down the stack, from shareholders to creditors to currency holders. The outcome was determined long before the crisis itself. This pattern appears across financial systems. When stability relies on conditions outside a country's control, pressure eventually tests that dependence. What happens next depends less on intentions and more on how risk, support, and obligations were arranged in advance.